All right, let's get right into it. How on earth do you figure out the true value of a massive 86-acre piece of land smack in the middle of a booming downtown? It's a huge question for St. Petersburg, Florida right now, and believe me, the answer is a whole lot more complicated than you might think.
See, you've got this incredible contrast. On one side, you have this enormous opportunity. 86 acres, currently the Tropicana field site, just waiting to be transformed into a whole new district. And on the other, you have the reality of a red-hot real estate market, where these super sleek, high-rise buildings on tiny little lots are selling for just eye-watering prices.
And when I say eye-watering, I really mean it. A developer recently paid over $51 million per acre to build a luxury condo tower. And get this, that was for a tiny parcel, less than half an acre. That's a record-setting number, for sure, and it sets a really, really high benchmark for land in downtown. So that leads us to the big mystery, right? If a tiny little lot can go for over 50 million bucks an acre, why isn't this 86-acre site, which is just a few blocks away, being valued in the billions? The simple math just doesn't add up. Well, the reason comes down to something called the economics of scale. When you're dealing with a project this massive, you can't just take the price of a small lot and multiply it. Nope. The entire way you value the land has to change completely. In the world of urban planning, they have a term for this, a large urban project. And here's the crucial difference. A small project, like that condo tower, it just reacts to the value of the neighborhood that's already there. But a project this big, it's so large that it basically creates its own neighborhood. It actually influences its own future value. Let's break that down a bit. Think about it. A small parcel can be built out pretty fast. It just plugs into the roads and sewers that are already there, and you have a pretty low risk of overwhelming the market with new units. A mega project, though? We're talking decades of construction in different phases. It needs entirely new infrastructure, new roads, new pipes, the whole shebang. And it carries this huge risk of building too much, too fast for the market to actually absorb. And you don't have to take my word for it. The experts at the Lincoln Institute of Land Policy say it perfectly. These massive projects create their own economic ecosystem. They don't just tap into existing value. They have to generate it from scratch over a really long time. Okay, so knowing all that, how do professional appraisers even begin to figure out a realistic starting point? Well, they calibrate. They look at actual, comparable sales in the area to see what the market has really been willing to pay. Now, this is where it gets super interesting. Look at the range here. You've got that art house trophy site way at the top. It's a total outlier at $51 million an acre. But then you see these other recent nearby sales that are way more grounded. They're landing somewhere between, say, $6.5 to $14 million an acre. This gives us a much more realistic band to start working with. But, and this is a huge but, even these prices are for pretty small lots, all of them under 2 acres. So the key takeaway here is that we absolutely cannot just apply these numbers directly to our 86-acre site. We have to make a professional adjustment for its sheer size. And this chart shows you the exact tool for that job, the size discount curve. It's pretty simple, really. As the side of a project goes up, the value per acre has to come down to account for all that extra risk and complexity we talked about. And as you can see, our 86-acre site falls into the highest tier, which calls for a massive discount, somewhere between 60 and 75%. Okay, so let's put all the pieces together. We can now take that real market data, apply that professional discount for size, and finally calculate a realistic, defensible value range for this specific 86-acre property. So after we run the numbers, what we get is a defensible range based on a few different market scenarios. A solid middle ground or market-normalized case lands at about $354 million. A more optimistic, strong market case comes in at $483 million, and a more conservative approach actually sets the floor at $562 million. The key here is that this isn't just one wild guess. It's a calculated range based on hard data and standard industry methods.
All right, so now we have our benchmark. The next obvious step is to take the actual development proposal that's on the table and see how it stacks up against this defensible market value range.
And this is where it gets really telling. The net value of the land in the proposal comes in at $140 million. And as you can plainly see, that is significantly below the fair market value range we just calculated. So what in the world is going on here? First, let's look at the headline number. The developer has proposed a gross payment of $202 million for the land itself.
But that number gets whittled down to a net value of $140 million. So the big question is why? What happened to that other $62 million? Well, the answer is in the massive value of public benefits that the developer is legally required to deliver. The cash price is lower because they're also contributing $50 million directly to community programs, they're paying $12 million to tear down the old stadium, and they're on the hook for building things like affordable housing, public parks, new infrastructure, and meeting goals tied to restorative justice. These are real, hard costs that get subtracted from the cash price of the land.
So, for city leaders and for the public, looking at this deal means you have to look beyond just one price tag. It means tracking all of these key performance indicators, or KPIs. Things like the price per acre, how much value is being captured by the public versus the private developer, and, crucially, the long-term leverage the city gets from this entire redevelopment.
And that leaves us with this final critical thought. For a project that is going to shape a city for the next 50 years, the true valuation isn't just about the sale price today. It's about the leverage that price creates for a better, more prosperous, and more equitable future for everyone.